The financial market seems like a vast ocean. Currents shift, tides rise and fall. Many believe these movements are random, or perhaps driven by the collective actions of millions of small investors. This is a comforting thought. It is also largely a myth. Beneath the surface, powerful forces are at work. These forces are not random, they are deliberate. They are the actions of smart money. This term isn't just jargon. It points to a crucial truth about who controls the game. Smart money refers to the big players. Think institutional investors, hedge funds with billions under management, investment banks with deep pockets, professional traders with years of experience. These are not your average retail traders. They have access to vast resources. Capital is just one part. They possess better information. They employ sophisticated tools and algorithms. Their decisions carry immense weight. A single large order can send ripples or even waves across the entire market, influencing prices significantly. Their role is not just about size, it is about influence. Smart money operators are the market makers. They are the liquidity providers, but they are also the strategic players. They aim to profit from inefficiencies. They often anticipate market trends, or more accurately, they help create them. Understanding their presence is the first step for any retail trader. Ignoring them is like sailing a small boat without checking the weather forecast. You might get lucky for a while, but a storm is always brewing. The influence of smart money is pervasive. It touches almost every asset class: stocks, bonds, currencies, commodities. No corner of the market is entirely free from their shadow. They operate on a different timescale. They plan moves weeks, even months in advance. Retail traders often react to news. Smart money often the news, or at least positions itself before the news breaks. Their goal is simple: maximize returns. This often comes at the expense of less informed participants. Knowing this is not about cynicism, it is about realism in a complex environment. Smart money doesn't just passively invest, it actively shapes the market landscape. One of their classic tactics involves exploiting stop-loss orders. Retail traders often place stop losses. These are designed to limit potential losses. A good idea in theory. However, smart money knows where these orders cluster. They can see large pools of sell stops below key support levels, or buy stops above key resistance points. These clusters become targets, a tempting source of liquidity for their large orders. They might initiate a stop run. This means pushing prices down just enough, just far enough to trigger those sell stops. This creates a cascade of selling pressure. The price dips sharply. Smart money then steps in. They buy at these artificially low prices. The retail traders who were stopped out are left bewildered. They sold at the bottom. Smart money accumulated shares cheaply. The market then often reverses, leaving retail traders behind. This is not an accident. It is a calculated maneuver repeated across various markets. False market signals are another tool in their arsenal. Smart money can create the illusion of a breakout. They might push prices above a key resistance level. This attracts breakout traders. These traders jump in, expecting the price to soar. Volume might even appear to confirm the move initially, but this can be manufactured volume. Once enough retail buyers are lured in, smart money reverses its position. They sell into the buying frenzy they created. The price collapses back below the resistance. This is known as a bull trap or bear trap. These manipulations are not always blatantly illegal. Often they operate in gray areas. They exploit market mechanics and human psychology. For instance, they might release or leak news selectively, or they might time their large orders to coincide with periods of low liquidity. This amplifies the price impact. The goal is always to create an environment where retail traders make predictable, emotional decisions that smart money can then capitalize on with precision and planning. How can a retail trader spot smart money activity? It's not always easy. These players are skilled at hiding their tracks, but they cannot hide everything. Two of the most powerful indicators are volume and price spread. Volume tells you the intensity of trading. Price spread, the range between high and low, tells you the effort. When smart money is active, these indicators often behave in specific ways. They leave footprints in the sand, if you know where to look. High volume on a narrow price spread can be telling. Imagine the price is trying to fall, but it meets huge buying pressure. The price doesn't drop much despite massive volume. This often signals smart money accumulation. They are absorbing all the selling. They are quietly buying without letting the price run up too quickly. Conversely, high volume on a wide spread after a long uptrend can signal distribution. Smart money might be selling their holdings to eager, less informed buyers at the top. The effort is there, but the price progress stalls. Low volume is also significant. If a market is rallying on low volume, be cautious. It might suggest a lack of genuine smart money participation. Such a rally can be easily reversed. It's like a building with a weak foundation. Smart money often tests the market. They might push prices slightly to see the reaction. If there's little opposing volume, they know the path is clear. This is part of their strategic probing. They are constantly gauging supply and demand dynamics before committing large capital sums. Understanding the relationship between price action and volume is crucial. This is the core of Wyckoff theory and volume spread analysis, VSA. These methods focus on the interplay. They seek to determine if smart money is accumulating or distributing. Is the effort volume consistent with the result, price movement? Anomalies often reveal their hand. For example, a sudden spike in volume with little price change near a key level. This is a red flag, or a green one depending on the context. It signals a battle is being fought. Section 4. Mind over Money, the Psychology of the Smart Money Playbook. Smart money doesn't just manipulate prices, they manipulate emotions. They understand retail trader psychology very well. Fear and greed are powerful drivers. Smart money uses these emotions to their advantage. They know how to create panic. They know how to induce euphoria. These emotional states lead to predictable, often irrational trading decisions. This predictability is what they exploit with cold, calculated precision. Their game is as much about mental warfare as it is financial. Consider how they use news. A piece of bad news hits the wires. Retail traders panic and sell. Smart money might have anticipated this. They might even have contributed to the news flow. They step in and buy from the panicked sellers. Later, when the dust settles, the price recovers. Those who sold in fear are left with losses. Conversely, during a strong bull market, they foster greed. They let prices run. They create a fear of missing out, or FOMO. Retail traders pile in at the top, just as smart money begins to distribute their shares. Patience is another psychological tool. Smart money can wait for months. They accumulate positions slowly, avoiding sharp price increases. This methodical accumulation can be boring. It doesn't create exciting headlines. Retail traders often lack this patience. They look for quick profits. They jump in and out of trades. Smart money, on the other hand, plays the long game. They understand that true wealth is built through disciplined strategy, not through impulsive actions driven by the day's fleeting emotions or market noise. They also exploit common cognitive biases. Confirmation bias, for example. Traders seek information that confirms their existing beliefs. Smart money can feed this. They can create signals that appear to validate a retail trader's analysis just before pulling the rug. Herding behavior is another. Retail traders tend to follow the crowd. Smart money can initiate a trend, then watch as the herd follows, pushing prices in the desired direction, until it's time for smart money to exit, leaving the crowd holding the bag. Understanding these psychological games is vital protection. Section 5. Brokerage smoke and mirrors, separating fact from fiction. Many retail traders believe their brokers are actively hunting their stop losses. This is a common narrative in trading forums. The idea is that the broker sees your stop, then they manipulate the price feed to trigger it. This allows the broker to profit from your loss. While this might sound plausible, especially after a frustrating loss, the reality is more nuanced. For most reputable, regulated brokers, this specific type of manipulation is unlikely and carries significant risk. Their business model often relies on commissions or spreads, not actively trading against clients. The vast majority of brokers, especially ECN and STP brokers, simply pass orders to the interbank market. They have little incentive to hunt individual stops. The liquidity providers or market makers on the other side of the trade are different. These are often the larger institutions, the smart money. They are interested in areas where stop losses congregate, but they are not your specific broker targeting your individual small stop. They are targeting large pools of stops. Your broker is merely the conduit through which your order reaches that wider, more predatory ocean. So who is hunting the stops? It is the collective action of large market participants. They see order book data in aggregate, though not individual retail stops typically. They identify price levels where many stops are likely placed. These levels act like magnets for price. If pushing the price to these levels allows smart money to fill large orders or engineer a reversal, they will do so. It's less about your personal broker, it's more about the structure of the market itself and the behavior of its largest participants. The effect on your account is the same, but the culprit is different. However, this doesn't mean all brokers are saints. Some less reputable B-book brokers might trade directly against their clients. In this model, the client's loss is the broker's gain. Here, the incentives for manipulation are higher. This is why choosing a well-regulated broker with a transparent execution model is crucial. But even with an honest broker, the market itself, driven by smart money, can still make it feel like your stops are being targeted. The solution lies in understanding market dynamics, not just blaming the messenger providing your trading platform. Section 6. Trading in their shadow, how retail can adapt and survive. Retail traders face a challenging landscape. They are up against formidable opponents, but it is not a hopeless situation. The key is to stop fighting smart money. Instead, learn to trade in their shadow. Try to identify their intentions, align your strategies with their likely moves. This requires a shift in perspective, from being a reactive victim to a proactive observer. It means thinking like they do, even if you don't have their resources or inside information. One crucial step is meticulous risk management. Smart money exploits predictable stop placements, so make your stops less predictable. Avoid placing them at obvious psychological levels. Consider using volatility-based stops, or even better, understand the market structure. Place stops where they invalidate your trade idea, not just at an arbitrary percentage. Also, never risk too much on a single trade. This protects your capital from the inevitable whipsaws and engineered moves that can occur in the short term. Patience and discipline are your greatest allies. Smart money operates on longer time frames. Retail traders should too. Avoid impulsive trading. Develop a solid trading plan. Stick to it. Wait for high probability setups. Setups that show signs of smart money accumulation or distribution. This might mean fewer trades, but potentially higher quality ones. Remember, trading is a marathon, not a sprint. Chasing quick profits often leads to quick losses when smart money is setting traps for the impatient. Finally, education is paramount. Learn about market mechanics, study volume spread analysis, VSA, understand Wyckoff's principles of accumulation and distribution. These tools are designed to decode smart money's actions. They help you see beyond simple price patterns. They reveal the underlying forces of supply and demand. By learning to read the tape, you can start to anticipate where smart money is positioning itself. This allows you to ride their coattails instead of being crushed by their movements. It's about trading smarter, not harder, in a market dominated by giants.